Hey everyone, and welcome to this seminar about how central banks can and should intervene in foreign currency markets to achieve their objectives. This is, in my opinion, an often overlooked topic because these days so many central banks have floating exchange rates and therefore emphasize less and less how intervening in currency markets is still a crucial tool of monetary policy. But as we will find out momentarily from Doug Lexton from the Better Policy Project and the Global Forecasting School, there is potentially actually a big role for FX or foreign currency intervention strategies if the interest rate is near the lower bound, so if it's near 0%. But first, we'll hear from Shalva Mukhatrasvili, who is the chief economist at the National Bank of Georgia, who will talk about so-called sterilized FX interventions and whether or not that name is adequate. So, Shalva, you have the floor.
Thank you very much, Yuri. Let me share my, my screen. So hopefully you should be seeing my slides in full screen mode. So as you mentioned, my talk is rather specific. Doug will talk about more broadly in terms of what sterilized, what FX intervention strategies do, why we may need them, how to deal with like broader macroeconomic conditions. But for today, I just want to zoom in on one particular aspect of FX interventions, and more specifically on sterilized FX interventions, to have more better understanding of the operational side and the potential side effects of this operational side. Uh, so let me directly dive into the topic. So the content of my presentation is essentially we first motivate why we are looking at this, and then we discuss potential side effects of those sterilized fixed interventions that we frequently do in Georgia. And then we compare these sterilized fixed interventions to standard quantitative easing operations, and then we will learn some key differences there, even though there are important similarities as well. And this all before we conclude. So the backdrop, the kind of a motivation why we want to have a better understanding of what these sterilized FX interventions do in Georgia, just like in any other small, open, especially emerging economies, which accumulate FX reserves, essentially going out in the foreign exchange market and buying FX, and occasionally selling FX as well to stabilize the markets. So the FX reserves have been increasing significantly in Georgia, which means that we need to have an understanding of how these operations on the FX market can be impacting, like more broadly, but also more like operational side, how it impacts the financial system. One argument that we frequently use that these FX interventions, even when we buy or when we sell FX, they are always sterilized, meaning that whatever is needed to make sure that these FX interventions do not have any impact on domestic currency, short-term money market interest rates, we do the corresponding operations. So, and this means that, for instance, if you go out to the market and buy FX, you are essentially providing domestic currency liquidity, and then you need another leg of this operation, and like another operation to mop up this liquidity that you just supplied to the domestic financial system. And we all always do this. So we sterilize FX interventions, and that's why if you look at the short-term interbank interest rates in Georgia, they are essentially pretty close, essentially equal to our policy rate, meaning that we are essentially enforcing policy rate in practice, meaning that FX interventions are always sterilized, so that whatever we do, as you see on the left-hand side, whenever we buy or sell, and as you see, we relatively frequently do that, they don't have any impact on short-term interbank or short-term money market interest rates. Exactly because we are sterilizing these FX interventions as is standard. But there is one big but. This sterilization means that there is no direct impact on short-term money market interest rates. And as I will discuss, and actually, by the way, this is how we define sterilized FX interventions. We say that when FX intervention has no impact on short-term money market interest rates, it means that it's sterilized. But that doesn't mean that they don't have impact on interest rates at all. They can have some impact on interest rates, and more importantly, on longer-term interest rates. That's what I will be showing in these slides. And they also have a direct potential direct impact on broad money aggregates, as opposed to quantitative easing, as we will see in a minute. So to show this, it's useful to look at the balance sheets because they give you kind of a very intuitive idea of what's going on behind these operations. That's what I will be using to show these operations, how these operations affect balance sheets of commercial banks or of the central bank. So as an example, I take these simple balance sheets. For instance, let's have a commercial bank that has domestic currency deposits as well as foreign currency deposits. So for simplicity, let me use lari as domestic currency, which is lari's Georgian currency, and use dollar as foreign currency. So banks have lari deposits and dollar deposits. And they also have lari liquidity and lari liquid assets and lari and dollar liquid assets. And then there is this central bank balance sheet, which is relatively lean, and it tells you that whatever reserve balances banks need in lari, it's provided by the central bank discount window. In Georgia, we call it refinancing loans, but it's in general just lending to banks to provide them liquidity that they need, for instance, to satisfy reserve requirements. So here, the important thing to note is that banks do have domestic currency or lari liquid assets, but some of these liquid assets are pledged in central bank operations. So when they borrow from the central bank, these reserve balances, they pledge government securities or similar assets which are eligible for these operations, part of collateral base. This will be important part, and let's have this in mind for now. So it means that even though the bank has 100 lari government securities, only 50 of them is free, so to say, for the bank to use. So now let's quickly have a discussion of what happens when the central bank does QE, quantitative easing, so that we can use these adjusted balance sheets after QE to use them to compare to balance sheets after FX interventions. So when the central bank does QE, it's like relatively simple operation. It means that a commercial bank will get liquidity from the central bank. It can use this liquidity to pay off the central bank discount window so that these encumbered or kind of locked government securities are freed, and then the bank simply sells these government securities to the central bank and gets reserves, newly created reserve money, lari reserve money from the central bank. The end result of this will be that now commercial bank has a lot of reserve money instead of government securities, and part of this reserve money will be just excess reserves, reserves that commercial bank doesn't need because reserve requirements do not necessitate that much reserves, and this means that bank will not hold this much reserves anyway. So end result, the final balance sheet of this simple operation is that for the commercial bank, asset side has changed a bit, but not that much. If you think about how much liquid assets this commercial bank has, it has the same amount of, so to say, free or unencumbered liquid assets. So kind of the same degree of liquidity on the of this commercial bank balance sheet. So it means that QE from the central bank didn't change much. The only thing that it changed is the duration of the asset that the commercial bank is holding. Previously, the commercial bank held government security, which earned like a long-term yield. Now the commercial bank is holding same type, like is still holding liquid asset. It's still in laris. It's just generating short-term interest rate because these excess reserves pay only this deposit facility interest rate that central bank is paying. So short now commercial bank is generating short-term interest. Before QE, it was generating long-term interest rate, long-term yield. So that's the only difference here. Otherwise, balance sheet of commercial bank is the same, which means that QE can only have a meaningful effect on term premium because now we are essentially forcing bank to think about whether short-term interest rate is better for its risk management practices or long-term interest rate is better. So now it is forced to hold these short-term interest rate generating assets instead of long-term one, so that it means that long-term assets become like a long-term yield becomes lower. It becomes more like a demand for it becomes higher, and it means that the term premium declines. So this term premium is something that QE works through, but beyond this, you don't see much effect on balance sheets, especially on liability side, or even on even if we had lending, the lending would not have changed much. So now let's turn to FX interventions and see within this simple example how FXI's impact on balance sheets differ from QE's impact. So we have essentially the same initial conditions, the same starting point. We have exactly same balance sheets as before. We just introduce households. As we will see, this will be important. So let's imagine that we have some households, so which were implicitly still there, but we just want to show them explicitly here. So those deposits that we said that commercial bank has on the liability side must be held by someone, right? So this household is holding these dollar deposits in this example. So now the question is, central bank wants to buy foreign exchange liquidity. Instead of buying government securities, which was an example of QE, now central bank wants to buy FX liquidity. So this is what happens when central bank buys FX liquidity of the same amount as as in the QE example. So let's assume that the exchange rate is 1-to-1, and the central bank bought $100. So by creating 100 laris worth of reserve balances, then we see here what happens is that for the commercial bank, FX position opens up. Why? Because commercial bank on the liability side still has same amount of lari deposits and more importantly, same amount of dollar deposits. So liability side has not changed in terms of currency composition, but on the asset side, things have changed. Why? Because in the QE example, central bank was buying one lari asset using another lari asset, so that FX position didn't change. Now it changes because central bank bought FX asset by lari reserve balances. When the commercial bank got these lari reserve balances in return to selling this FX reserves to the central bank, it essentially has now more lari securities relative to lari liabilities, and this is an FX open FX position. In this case, it's short in dollars, so that if there is a if there is like a depreciation of the dollar, then this can have a like negative impact. This means that banks, because banks have prudential regulation that forces them to have a closed FX position, or like a close to zero net open position. It means that this commercial bank will be forced to buy FX on the from someone else. And in this example, the simplest way would be to buy this FX from households, because households are those agents in our example that have this foreign currency money in the system. When the bank does it, it is essentially kind of issuing domestic currency liability and use it to buy off this foreign currency or pay off this foreign currency liability. Essentially, issuing domestic currency deposits, which is kind of money, issuing this money to buy this dollar deposit from household. It's essentially kind of a incentivizing household to convert its foreign currency deposit into lari deposit. In this example, that's the only way for this bank to close this FX position. Another example could be that these commercial banks simply using this lari reserve money to buy dollar on the interbank market, but for the aggregate financial system, this doesn't change position. That's why we are using this example when banks buy FX from households. We can have corporates, non-financial corporates as well, but the result will be the same. So let's have a look at the final balance sheets from the after the FXI from the central bank. When the bank sells FX to central bank and it closes FX position, so this is how things look. Now banks have closed FX position, but household was kind of incentivized to sell its dollar deposit, and now instead household has these lari deposits, which is essentially equivalent to increasing broad money aggregate. But let me do this comparison in a minute. Before we move on to comparing commercial bank balance sheet after QE versus after FX intervention, let's have a look at the central bank balance sheet. Here, if we concentrate on the liability side, because that's the part of central bank balance sheet that matters in terms of liquidity conditions in the economy, because liability side shows reserve money, reserve balances, or sometimes called like lari supply from the central bank. And lari supply is the same across these two examples, which means that like a sterilization of FX intervention can work perfectly well. Lari's price, which is short-term money market risk-free interest rate in the system, can be exactly the same across these two cases. So on the liquidity side, nothing really changes in QE versus FX side. But when it comes to commercial banks, then things do change. And here I provide two important differences. One difference is that when central bank does FX intervention, commercial banks retain lari liquid assets that they had before and get another additional lari liquid assets. It essentially means that banks now have a more high quality liquid assets in lari. So this HQLA that we, in short, this HQLA is important determinant of commercial banks like balance sheets health in terms of liquidity risk. If HQLA is higher, it's more likely that this bank is less afraid of liquidity risk and can be more aggressive in extending loans and extending money creation, like increasing money creation. So this more HQLA in an environment when a bank can be afraid of liquidity risk, in this environment, when HQLA is expanded, it means that banks can be more aggressive in lari lending, in domestic currency lending, so that domestic currency lending interest rates can decline because banks will be more aggressive in pushing out loans because now they are not afraid of liquidity risk as much as before because now they have a higher HQLA. That's one difference. And the other difference is that, and this is kind of a mechanical difference as well, when FXI forces banks to close their FX positions, it means that domestic currency broad money aggregate will automatically expand. Of course, this is partial equilibrium effect. In general equilibrium, we know that if like overall supply of domestic currency broad money is too much for the economy to absorb, then someone will use this excess kind of a broad money in domestic currency to pay off domestic currency liabilities, and this will quickly distract money, and then the broad money kind of a supply will go back to its pre FXI level. So that what can happen in general equilibrium. but it's important to have good understanding of what is the path that we go to that point. And to understand this path that we go to that point, we need to understand this partial equilibrium or mechanical effect on broad money aggregates as well. Because this will define dynamics in different countries, this can have a different impact. So that it's important to have these operational or mechanical effects of FXI in mind. And given country circumstances, they can be important, but they can have negligible effect. So sometimes, if the FX market financial system is more developed, these aspects may not be relevant because HQLA of banks can be high already, so that there is no need to care about it. Or broad money aggregates may not have much effects because of high substitutability between domestic currency and foreign currency monies. But in some cases, when HQLA it can be an issue when collateral base is not high enough, or when substitutability between domestic currency money and foreign currency money is not high. These impacts can be meaningful. So that's why it's important to have this in mind. So just a quick note on the quantitative importance of this in Georgia. We did this kind of mechanical or accounting-based decomposition of broad money change. So we took M2, which is broad money measure that we most frequently look at. We looked at its change, and then decomposed this change based on accounting identities. We looked at the monetary survey, which is balance sheet of central bank plus balance sheet of other depository corporations. And if you decompose this change in M2 by driving forces, by other items on the balance sheet, you see that, as is something that we have understood for quite some time, the major driver of M2 is lending to non-financial sector. This is green bars. So essentially, lending creating M2 as is something that we already knew. But for quantitative purposes, to see whether FX interventions have been important or not, it's useful to look at other driving forces. And in this case, these red bars show impact of FX interventions, like a first round or mechanical impact. Of course, in general equilibrium, the final impact can be different, but this is accounting-based decomposition, mechanical kind of a decomposition. First round, maybe we can call it first round impact. If you decompose these accounting balance sheets, you see that contribution from FX interventions on broad money aggregate or pressures on broad money aggregate from FX interventions. Sometimes when we had like active FX intervention episodes, like in 2020 during COVID, when we sold quite a bit, or in 2023 when we bought quite a bit of FX, this contribution from FX intervention has been almost as high as contribution from Lari loans, Lari credit, which means that while the bank lending remains the key driver of broad money, sometimes FX interventions can be of similar magnitude, which means that in our case, it's important to have understanding of these issues. Of course, whether it has an impact on inflation or on exchange rate in the direction that one may expect, it depends on driving forces. Because we are buying FX during a time when there is demand for lari, it means that FX intervention is not generating any inflationary pressures, because if anything, inflation was declining during this time because demand for lari assets was increasing. People were converting from foreign currency deposits into lari deposits, so demand was for lari was high, and essentially FXI was a tool to expand broad money supply, so to say, in line with its kind of underlying demand. So that means that impact on prices can be hidden, but at least on a mechanical level, you can see how much this contributed to satisfying this demand for broad money. So let me summarize with this. We kind of showed with simple examples. So these are balance sheet identities, like examples that are trivially true. What happens in general equilibrium is a different thing. We need a macro model for understanding this, but at least having these mechanical impacts or kind of the side effects of FXI in mind helps us to build like a more realistic models or do a more realistic analysis of the final effects. So the conclusion is that even though FX intervention, when sterilized, has no impact on short-term money market interest rates, they potentially can have impact on longer-term domestic currency interest rates, like lari interest rates, and they also can have some impact on broad money aggregates. And with that, let me conclude. Thanks. And this presentation, like big part of it is based on our paper, which is forthcoming in International Journal of Economics. And in case you are interested, you can have a look at using this barcode. So that's all for me. And thanks again. Looking forward to discussion.
Right, Shalva. That was very interesting. Thank you so much. I have a question, because that was going a little bit fast for me. Can you maybe go into a bit further? Why does an FX, or how does an FX intervention mean, or like why does that mean that the interest rate is not changed by, I guess, exports exceeding imports? That's how you get this FX in the country, right? Or perhaps by borrowing it, of course.
Yes, FX can be flowing into the economy by any means. Like most obvious example would be exports. When we produce something, we export this, we get a fix in return, so that it's kind of a export companies or households that own these export companies, or someone who bought FX from these export companies. Whoever is holding this FX is a potential source of FX reserves for central bank. Eventually, when central bank buys FX from banks, then banks have to buy it from someone else, because banks cannot sell FX to the central bank without having without acquiring this FX either in advance or later from someone else, because this will uh, open commercial banks FX position. When banks have this like a given composition currency composition of liabilities. For instance, they have, in this example, they have 100 lari deposits, they have 100 lari, $100 deposits. It means that they have to have similar composition on the asset side. In this example, FX position is closed because against these 100 lari deposits, they have this 100 lari government securities. So they are this deposit as well as these securities are in the same currency. And when they have these $100 deposits on the asset side, they have corresponding $100 FX liquidity. They can also have FX loans, as long as there is something that's in the same currency. It's fine for banks. But when FX intervention happens, this means that banks are giving these FX to the central bank and getting lari assets in return. It means that now banks have these dollar deposits still as before, but they no longer have FX assets on their asset side. And this is something that banks cannot continue with for long. They have to deal with this, because in this example, if exchange rate depreciates, if dollar depreciates, well, actually, the example should be if lari depreciates against dollar, it means that banks will have these $100 deposits in lari terms will expand, but the asset side doesn't change. So it means that banks will lose money. Essentially, their capital will be eaten, so that their capital declines, and in extreme cases, this can result in bank default. For that reason, commercial banks are by regulation required not to have a too big open FX position. So that's why even when central bank buys FX and this FX is bought from a commercial bank, indirectly this FX is always bought from someone else, like from households or from export companies or
Yeah, no, no, this part was clear to me, but how is this sort of protecting the interest rate, the short-term interest rate? Like, why is the central bank doing this intervention? It's to keep the interest rate, as it was before,
Yes, the
right?
FX intervention can be with the aim of like increasing FX reserves of the central bank. Like in this example, so the central bank has only domestic currency assets. If it wants to accumulate FX reserves for whatever reason, like we are small open economy, we need to rebuild our buffers because in the future we may need some FX, like whatever the reason, central bank may want to buy FX, and this is central banks do these FX interventions. In this case, purchase FX intervention. But then when it comes to sterilization, in this example, sterilization essentially means paying interest on your reserve money. So when we were in this example comparing central bank balance sheet after QE and after FXI. So after QE, this is very kind of a well studied example for advanced economies like US, Eurozone, ECB, the Fed, and ECB. They have been paying interest on excess reserves. So whatever reserves commercial banks hold, they are getting interest, like an interest rate equal to policy rate from the central bank. So
Hmm.
this is interest on excess reserves, and this makes sure that on the in the market, in the short-term money market, interest rates are unchanged because if central bank is paying you the same interest rate, you don't have any incentive to ask someone else, some other private agent to pay you different interest. So interest rates in the money market, in the short-term money market, remain the same because central banks manage their balance sheet and pay interest accordingly. But that doesn't mean
Right.
that things are the same across these two examples because commercial bank's
So,
balance sheet is different.
so is it about, can you say that it is about keeping your monetary policy effectiveness sort of at the same level? Because like if commercial banks have too much foreign assets on their balance sheets, then they effectively are dealing with interest rates from a foreign central bank as well as you. And so through sterilizing, they only dealing with your interest rate. Is that, can you see it like that?
Um, yes, that can be like an end result is that our monetary policy decisions are enforced in the same way as before. This is the end result of the sterilization leg itself. But the FX purchase part can be of different reasons. Like most of the cases, it's for the reasons of central banks accumulating FX reserves for like bad times.
Yeah.
Sometimes central banks buy FX just to slow down appreciation. But the sterilization leg itself, it's just for purely for monetary policy purposes to make sure that monetary policy decisions are enforced in the same way as before FX intervention.
Yeah. And if you said like one of your main conclusions was so these FX interventions increase the money supply, right?
Yes.
Um, can you look at it like if you go one step sort of back or like back in time, can you look at it as like let's assume this FX comes from exports, right? So excess exports over imports, that is.
Yeah.
So if your country exports more than it imports, it earns money, right?
Yes.
However, it earns foreign money.
Yes.
And through this intervention, your citizens now have essentially earned local money. So
Yes.
could you say that what increases the money supply is not necessarily the FX intervention, but it's actually the exports. But in combination, like that increases money, foreign plus local, but through the intervention, it is translated to being local money only.
Yeah, that's exactly right.
Okay.
So this the initial source can be anything. So that's what I meant by general equilibrium. So in general equilibrium, final effect as well as initial cause can be completely the same. But when there is a step in this process concerned with what central bank does, this is what it has to go through to convert, as you mentioned, to convert this foreign currency money into domestic currency money. But overall, that's a good example.
And so, final question for other central bankers watching. What's sort of the takeaway lesson from this? Have they been thinking about FX intervention wrong, or should they do something differently? What's sort of the takeaway for a central banker that's watching?
The takeaway would be it depends on country circumstances. If you are a country which has uh, collateral base for central bank of operations that's not big enough, and FX liquidity is not part of this collateral, then FX interventions can have a meaningful effect on banks' liquidity fears. So this is equivalent to saying that FXI has an impact on domestic currency HQLA, and if HQLA for banks is something that's constraining, then it can affect bank lending, and that's one thing to take into account. So if you are doing FX interventions in big amounts, this can have an impact on domestic currency lending. And the other is this domestic currency broad money, which is kind of a related part because impacting domestic currency lending and impacting domestic currency broad money is like equivalent because we know that lending is creating deposits. So the bottom line would be that looking at the circumstances can tell us whether these effects can be important, and this can if they are if they seem to be important, like collateral base is small, uh, substitutability between foreign currency money and domestic currency money is low, then these considerations should also be fed into decisions how much to intervene on FX market. So the quantitative part is difficult to show because here we are just showing the conceptual effects, but at least this is something that uh, reminds us that these effects are something to take into account.
So could it then also be that okay, because you mentioned you want to have more reserves, more foreign currency reserves. This could be motivation to do these types of interventions. But because you're saying the consequence can be that there will be more bank lending in the economy,
Yes.
it could actually be that a side effect will be that there will be an asset boom in your economy, for example, or a bubble, right?
Yes, it can
That,
be. And there are some papers which argue that they see some empirical support for that kind of claim. But it's not probably very clear. But at least this is like a channel through which you can explain such an effect when you accumulate FX reserves, and at the same time you help domestic currency lending, which can either be good. So the side effects can be like a positive or negative from different countries' perspectives. But supporting lending while accumulating FX reserves can be useful for you, or can be against you if you are trying to avoid credit boom.
yeah. All right. I think that's a really interesting takeaway. Thank you so much